High-yield bonds versus corporate bonds, understanding the risks and returns. Once upon a time, there were two companies called KeTuan and MuXing. Both of them were financial companies that made money by providing loans and issuing bonds. One day, KeTuan wanted to raise some money, but didn't want to sell stocks, so they decided to issue corporate bonds. Since KeTuan had good credit, had a lot of assets, and had receivables as collateral, the risk of bond default was very low and it was rated AAA by S&P. Therefore, KeTuan only needed to issue bonds at a 3% interest rate, which was the risk-free rate of return plus 1% risk premium. On the other hand, MuXing also needed to raise money, but its credit rating was only CCC, which means there was a risk of default, so its bonds were called high-yield bonds, also known as junk bonds. The interest rate for MuXing's bonds was the risk-free rate of return plus 5% risk premium, or 7%. The value of bonds is a concept of relative discount rate and fluctuates with changes in market interest rates. Currently, the market interest rates are high, and the bond prices are low. Therefore, buying high-yield bonds now may have relatively significant returns, but you need to consider the risk of default. In addition, the length of the Federal Reserve's interest rate hike cycle also affects bond prices. If the interest rate hike cycle remains high, future financing will be more difficult, increasing the risk of company bankruptcy. Therefore, the company's cash flow situation is also very important. In summary, whether an investment is worth it depends on the ratio of risk to return. If the return is much greater than the risk, then it is worth it. But if the risk is too high, then you should still think carefully. After all, knowledge is not only power, but also money.